Hi there, and welcome to the Retirement Wealth Podcast. Today, we're diving into a topic that I think a lot of folks are really curious about. How to pay zero taxes in retirement. Legally, of course. It sounds like a dream, right?
Absolutely, Emily. I mean, who wouldn't want to keep more of their hard-earned money?
Exactly. So we're going to unpack some strategies that can help you maximize your retirement income while minimizing your tax burden.
We'll cover things like tax-efficient withdrawal strategies, the benefits of Roth accounts, and even some tips on how to manage your investments to keep your taxes low.
Yeah, and it's not just about avoiding taxes. It's about smart planning, too. We want our listeners to feel empowered and informed as they approach retirement.
That's right. And, it's crucial to have a solid plan in place. It can really make a difference in your financial freedom during retirement.
So whether you're just starting to think about retirement or you're already enjoying that well-deserved time off, there's something here for you.
Let's get into it.
Yeah, let's dive into the first strategy. So, David, what's the first thing people should consider when thinking about taxes in retirement?
Emily, the importance of tax efficiency in retirement planning, especially right now, really can't be overstated. With the economic climate as it is, many folks are feeling uncertain about their financial futures.
Absolutely, David. And I think a lot of people are starting to realize that every dollar counts, especially with inflation creeping up like it has. It's not just about having enough money saved, but also how much of it you get to keep, right?
Exactly. I mean, I've spoken with clients who thought they were set for retirement, only to find that rising prices and taxes could eat into their savings more than they anticipated. For instance, I had a couple, let's call them Tom and Lisa, who were planning to travel extensively in retirement. They had saved diligently, but when we sat down and crunched the numbers, we realized their tax liability could significantly reduce their travel budget.
That's such a common scenario. It's like they've worked so hard, and then they find out about these hidden costs that, could impact their lifestyle.
Right. And with market volatility, there's even more pressure. One day the market's up, the next it's down. It can make it hard to stick to a solid plan. I remember another client, Sarah, who was nearing retirement. She had a substantial portfolio, but was terrified of market dips affecting her retirement income. We had to find ways to mitigate those risks while keeping her tax efficient.
So what can people do? It seems like many are in the same boat, worrying about how to maintain their lifestyle as costs rise and the economy fluctuates.
Well, first, it's about understanding your timeline. If you're planning to retire in the next few years, you really want to have a solid strategy in place. Like, you don't want to be in a position where you're forced to sell investments at a loss or take distributions from accounts that could trigger high taxes.
That's a really good point. Timing can be everything, can it? Also, I think the emotional side of it shouldn't be overlooked. Many people feel a lot of anxiety about retirement and financial security.
Absolutely. I've had clients tell me that just knowing they have a plan in place has eased their worries tremendously. It's like they can finally breathe. One couple I worked with, John and Mary, were both feeling overwhelmed by the thought of healthcare costs in retirement. Once we outlined a strategy for managing those expenses and keeping their tax situation in check, they felt a lot more secure and hopeful about the future.
That's so encouraging to hear. It's amazing how much peace of mind can come from having a clear plan. And I think with Social Security changes looming, it's becoming even more crucial to have these conversations now.
Definitely. Many people aren't aware that the way they choose to take Social Security can impact their tax situation significantly. It's not just about the amount you receive, but when and how you take it. I had a client, let's call him Mike, who didn't realize that if he started taking Social Security too early, it could push him into a higher tax bracket later.
Wow, that can be a real eye-opener. And, with healthcare costs skyrocketing, it's another layer of complexity.
For sure. There's this misconception that Medicare will cover all healthcare expenses, but that's not really the case. There can be hidden costs that add up, and without planning for those, it can really derail someone's retirement budget. I had a retiree, let's say her name was Karen, who was shocked at how much she had to pay out of pocket for her prescriptions after she retired.
That's such a relatable scenario. It's easy to focus on the big numbers in a retirement plan, but those smaller ongoing expenses can really add up.
Absolutely. And that's why, when we talk about legacy planning, it's critical to be tax efficient, not just for you, but for your heirs as well. If you can structure your assets in a way that minimizes taxes, you're leaving more for your loved ones.
That's a great point, David. I think many people want to ensure they're leaving a meaningful legacy without burdening their family with tax implications.
Right. It's all about being strategic. For example, if someone has a traditional IRA, those distributions will be taxed as income for their heirs. But if they can shift some funds to a Roth IRA, those funds can be passed on tax-free.
It's like a gift that keeps on giving. You're not just thinking about your needs. You're considering the future as well.
Exactly. And that's why it's so important to stay informed about current economic trends, tax laws, and financial strategies. The landscape is always changing, and what worked a few years ago might not be effective today.
So it really comes down to being proactive, right? The earlier you start planning, the more options you have.
Yes, and understanding how to pay zero taxes legally in retirement is a huge part of that proactive approach. We'll dive into some specific strategies in a moment, but just knowing that there are ways to navigate these waters can really put people at ease.
I can't wait to hear about those strategies. It's clear that being aware of these factors now can really make a difference in how people enjoy their retirement years.
So Emily, we've talked about the importance of tax planning and retirement, but let's dive into some core strategies, right?
Absolutely, David. I mean, it's one thing to know taxes can eat into your retirement savings, but understanding how to minimize that impact is key.
Exactly. One of the foundational tools is, of course, tax-advantaged accounts like 401ks and IRAs. For example, with a traditional 401k, you can contribute pre-tax dollars, which lowers your taxable income in the year you contribute.
Right, and then when you withdraw in retirement, that money is taxed as ordinary income. But there's also the Roth option, where you pay taxes up front.
Exactly, and that's such a powerful strategy, because if you anticipate being in a higher tax bracket later on, paying those taxes now can save you quite a bit.
So if someone is, say, 55 and still working, contributing to a Roth could be a smart move. But what about folks who are already retired?
Great question. For retirees, managing withdrawals from these accounts is crucial. You know the 4% rule?
Yeah, that's the one where you can withdraw 4% of your retirement savings each year, right?
Exactly. It's a guideline to help ensure you don't outlive your savings. So if you have $1 million saved, you could withdraw about $40,000 a year.
But that can get tricky with taxes. If all of that comes from a traditional account, that could bump you into a higher tax bracket.
Right, which is why diversifying where your income comes from is so important. If you can mix it up with Roth withdrawals, Social Security, and maybe even some dividends from stocks, you can minimize taxes while still meeting your needs.
Speaking of Social Security, how does that fit into the tax picture?
Social Security can be a bit of a double-edged sword. Depending on your overall income, up to 85% of your Social Security benefits can be taxable.
So it's really about timing and planning your withdrawals?
Exactly. If you can keep your other income low, say by drawing from tax-free sources, it might allow you to take more of your Social Security benefits without getting taxed heavily.
That's super insightful. What about bonds? They're often seen as a safer investment, but how do they impact taxes?
Good point. Interest from most bonds is taxed as ordinary income, which can add up. That's why municipal bonds can be appealing. They're often exempt from federal taxes, and sometimes state taxes too.
So if someone's looking for a tax-efficient income stream, municipal bonds could be a good choice.
Exactly. And let's not forget real estate. If you sell a primary residence, you can exclude up to $250,000 in gains if you're single, or $500,000 if married, right?
Yes, that's a huge tax break. But what if you're not selling your home?
If you're holding on to it, you might consider a strategy like a 1031 exchange, which lets you defer taxes on gains from an investment property by reinvesting in another similar property.
Oh, that's interesting. It's like a way to keep your money working for you without the tax hit.
Exactly. And let's not ignore annuities. They can provide tax-deferred growth, and if structured properly, can provide income in retirement that may be taxed at a lower rate.
So they can be a solid addition to a diversified portfolio?
For sure. And speaking of diversification, It's crucial to have a balanced asset allocation. A common rule of thumb is the 70-30 portfolio, 70% stocks and 30% bonds, though that can vary based on individual risk tolerance.
So if the market does well, you're positioned for growth, but the bonds help cushion the blow during downturns.
Exactly. And within that allocation, think about tax efficiency. You might want to put less tax-efficient investments, like bonds, in tax-advantaged accounts, and keep stocks in taxable brokerage accounts.
That's a smart way to optimize your tax situation.
And remember to consider the sequence of withdrawals as well. This is where strategies like the bucket strategy come into play.
Right, the bucket strategy, where you create buckets of money for different time frames, right?
Yes. You could have a short-term bucket for living expenses in the first few years of retirement, a medium-term bucket for income in years 5 to 10, and a long-term bucket for growth.
And by only withdrawing from the short-term bucket at first, you can let the long-term investments grow, potentially resulting in lower tax implications.
Exactly. It buys you time and flexibility.
So it's all about being proactive, not reactive.
Absolutely. And if you don't plan ahead, you might end up in a situation where you're forced to sell assets at an inopportune time, potentially realizing gains you didn't want to.
That's a real risk. And what about RMDs? They can really complicate things, can't they?
Yes, required minimum distributions from traditional IRAs and 401ks kick in at age 72. That forces you to take money out, whether you need it or not, and that can push you into a higher tax bracket.
So planning how and when to withdraw from those accounts is essential.
Exactly. That's why having a solid withdrawal strategy is so important.
And it sounds like there are a lot of moving parts to consider.
There definitely are, and it can get overwhelming. But if you take it step by step and work with a financial advisor, you can create a strategy that not only minimizes taxes, but also aligns with your retirement goals.
That makes a lot of sense. But there are common pitfalls to watch out for, right?
Absolutely. Let's talk about those next. So, Emily, one of the biggest pitfalls I see time and again is something called sequence of returns risk.
Yeah, I've heard that term thrown around a lot. But what does it really mean for someone who's retired or planning to retire?
Well, it's all about the order of your investment returns during retirement. If you experience a market downturn early on and you're withdrawing from your savings, it can really deplete your portfolio.
Right, so if someone has a bad year right out of the gate, that can set them back significantly, huh?
Exactly. I had a client, let's call him John. He retired in 2008, right when the market crashed. He was relying on his portfolio to fund his retirement, but those early losses meant he had to withdraw more to cover his expenses, which, compounded the problem.
That sounds tough. What could he have done differently?
Well, if he had a more diversified portfolio, or perhaps a strategy that included a cash reserve for the first few years of retirement, he might have weathered that storm better. It's all about having that cushion to avoid selling investments at a loss.
That makes total sense. Another thing I hear a lot about is people ignoring taxes when they're planning their withdrawals.
Oh, absolutely. Many retirees underestimate how taxes can eat into their income. I had a couple who, let's say, underestimated their tax bracket. They were pulling money out of their traditional IRAs and ended up in a higher tax bracket than they anticipated.
Oof, that's a classic mistake. So what happened to them?
Well, they ended up paying a lot more in taxes than they had planned, which left them with less spending money. They thought they were being smart by taking larger distributions to enjoy their retirement, but it backfired.
So what should people do to avoid this kind of situation?
A solid strategy is to plan your withdrawals carefully. You want to mix your income sources, taxable, tax-deferred, and tax-free accounts, so you can minimize your tax impact. A lot of folks don't realize that, taking from different pots can make a huge difference.
That's a great tip. Speaking of planning, I imagine underestimating healthcare costs is another common mistake.
Absolutely. Healthcare can be one of the largest expenses in retirement. I had a client, let's call her Susan, who thought she'd be fine with Medicare alone, but she didn't account for the out-of-pocket costs and long-term care needs.
Wow, that's a big oversight. How did that impact her?
Well, she ended up having to dip into her savings much faster than she expected, which made her feel insecure about her financial future. It's important to factor in not just premiums, but also deductibles, copays, and potential long-term care.
So what should retirees be doing to prepare for these healthcare costs?
Building a comprehensive plan that includes potential healthcare expenses is crucial. Look into supplemental insurance options and also consider long-term care insurance if it makes sense for your situation.
That sounds like a smart approach. Now, I've also heard about folks misallocating their assets. What do you see happening there?
Yes, asset allocation is key. I had a couple, let's call them Mike and Lisa, who were super conservative. They had a huge chunk of their portfolio in cash because they were afraid of market volatility. But that left them vulnerable to inflation.
So they missed out on growth, huh?
Exactly. They hadn't considered how inflation could erode their purchasing power. A well-balanced portfolio should include a mix of growth, income, and safe assets tailored to their risk tolerance.
That's a vital point. And what about Social Security? I know people often have misconceptions there too.
Oh, definitely. Claiming Social Security too early is a huge mistake I see. I had a client, let's call him Tom, who claimed at 62 because he was eager to start enjoying his retirement. But he didn't realize he was leaving a lot of money on the table.
Right, because the longer you wait, the higher your benefits become, right?
Exactly. If Tom had waited until 70, he could have significantly increased his monthly benefit. It's important for people to understand the long-term implications of their claiming decisions.
So what advice do you have for someone considering when to claim?
I always suggest looking at your overall financial picture. Consider your health, your need for income, and your longevity in your family. It's not a one-size-fits-all decision.
Those are really valuable insights, David. Are there any other red flags retirees should look out for?
Sure. One major red flag is having no plan or not revisiting your plan regularly. Life changes, and so should your strategy. If you're not reviewing your investments or your expenses annually, you could be missing out on opportunities or facing unexpected challenges.
That's a great point. It sounds like being proactive is key to a successful retirement.
Absolutely. And if you notice any of these pitfalls in your own planning, don't be afraid to reach out for help. It's never too late to adjust your strategy and get back on track.
So what would be the next steps for someone who might be feeling overwhelmed by all this?
First, take a deep breath and start by assessing your current financial situation. Identify any areas where you may need to adjust your plan. And don't hesitate to consult with a financial advisor who specializes in retirement planning. They can help you navigate this journey.
That sounds doable. Thanks, David. This has been so informative.
My pleasure, Emily. It's important to empower listeners with the right knowledge so they can enjoy the retirement they deserve. So, Emily, now that we've explored how to potentially pay zero taxes in retirement, let's talk about the next steps. What can our listeners do right now to improve their retirement plans?
Absolutely, David. I think one of the best things they can do is start by reviewing their current financial situation. It's like a checkup, right? Just to understand where they stand.
Exactly. And a great first step is to pull out those retirement account statements. Look at your 401k, IRAs, and any other retirement savings. Get a good picture of what you have.
Right. And once you've got that, consider using some online calculators. Vanguard, Fidelity, and Charles Schwab all have fantastic retirement calculators. They can help you project your savings and see how different strategies might impact your taxes.
Yeah, those calculators are super helpful. And if you're looking for something a bit more interactive, there are financial planning apps out there that can help you run various retirement scenarios. You know, apps like Personal Capital or Mint can be great starting points.
That's a good point. And let's not forget about Social Security, right? It's a big piece of the puzzle for many retirees. Checking out SSA.gov can give you insights into your benefits. You can even run estimates based on your earnings record.
Totally. And speaking of estimates, running a retirement projection is vital. Just take some time, maybe quarterly, to review your portfolio's performance and reassess your goals.
Yes. And when you do that, think about tax-efficient strategies. You can consider Roth conversions or adjusting your withdrawal strategies.
And if you're looking for expert advice, there are plenty of books out there. I always recommend The Boglehead's Guide to Retirement Planning. It's practical and straightforward.
Oh, that's a classic! And for those who prefer podcasts, The Retirement Answer Man is a fantastic resource. He dives into actionable tips and strategies, making it really easy to digest.
Absolutely. And it's not just about consuming information. It's about taking action. Start small. Create a habit of reviewing and adjusting your investments regularly. Even just setting a reminder to do this quarterly can make a big difference.
Exactly. It's all about consistency. And if something feels overwhelming, remember, it's never too late to improve your plan. Just take those first steps.
Right. And speaking of first steps, another great tool is tax software. Programs like TurboTax or H&R Block can help you see how different decisions impact your tax situation.
That's a great idea. Plus, they often have resources to help you understand the tax implications of your retirement accounts.
And don't overlook the power of professional advice. If you're feeling unsure, maybe consider talking to a financial advisor. A good one can help tailor a plan that suits your specific needs.
Yes! Finding someone who understands your goals and concerns can really help you feel more secure about your decisions.
And remember, it's okay to ask questions. Be curious about your own financial future. That's how you learn and grow.
Absolutely! And it can be really empowering, right? Knowing you're taking active steps towards a more secure retirement can change your mindset completely.
Yes, it can. And as you implement these steps, keep an eye on your progress. Celebrate small wins, whether it's hitting a savings goal or simply feeling more informed.
Yes, building good habits doesn't happen overnight. But with consistency and the right tools, it's definitely achievable.
So those are some practical first steps. Now let's bring this all together. Well, Emily, looking back at our conversation today, it's clear there were some real gems for our listeners on how to pay zero taxes in retirement.
Absolutely, David. I think one of the key takeaways has to be the importance of tax-advantaged accounts. I mean, utilizing tools like Roth IRAs and 401ks can really make a difference, right?
Exactly. And don't forget about the power of tax loss harvesting. That strategy really can help offset gains and minimize your tax burden.
Yes, and we talked about how essential it is to plan for your withdrawals carefully. Timing those withdrawals can not only impact your tax situation, but also your overall retirement income.
Right, and let's not overlook the benefits of charitable contributions. Donating appreciated assets can really be a smart way to lower your taxable income while doing good.
Oh, for sure. It's like giving back and getting a tax break all at once.
And finally, I think we both emphasize the importance of consulting with a financial advisor. It's crucial to navigate these strategies effectively and ensure you're taking full advantage of what's available to you.
Definitely. You know, retirement is about building and protecting your wealth, and these strategies can really help you do just that. It's all about making informed decisions that align with your goals.
And to our listeners, if you found value in today's episode, we'd love for you to like, subscribe, and share your biggest takeaway or any questions you might have in the comments.
Yes, and if you know someone who's planning for retirement or already in it, share this episode with them. You never know who might benefit from this information.
Next time, we'll dive into the best places to invest in real estate for retirement income, a topic that's sure to spark some interest.
Can't wait for that one. Thanks for joining us today, and we hope you have a fantastic day ahead.
Take care, everyone.